Hi, welcome to the Market Alert for Monday, the 27th of February 2017. So on Friday, we saw the market open with a buy signal. We saw this filled, and as the market traded sideways, I sent out a note to say that should the market get to the scalp or to the 20,800 level, I was going to exit the trade because the market just didn't look like it had anything going for it. And in fact, if I just bring this back a bit, you can see how the volume increased here with this price bar where the market had just hit and gone through the scalp and heading towards the 20,800. So there was some selling that came into the market that stopped this move. The market then returned. There was a buy signal that was then eventually filled a bit later on at 15.35, and then we see the market trading sideways, finding support at the 20,750 level. And as we went on into the evening session, the market still remained down in these lows, and then just before the close we see the market ramp back up to the 20,800 level. Now, for many weeks I've been talking about the Trump effect, and when I talk about the Trump effect, I mean Trump supporters buying into the market, i.e. the retail buyers. This is now being confirmed, and I've recorded videos and shown about the distribution and market moving higher, the institutional investors getting out and the retail investors being sucked into the market. Well, in an article that was released on Friday, JP Morgan, institutions, hedge funds are using the rally to sell to retail. And as it says here, last week we reported that for the first time since the election, Bank of America's smart money clients were, as a group, selling stocks. As Bank of America's Jill Carey Hall calculated, after a significant buying over the past few weeks, net client sales of $2.1 billion were the largest since June. However, there was a further nuance, one which has emerged as troubling for those calling for sustained gains in the market, and that's on one of those. It's just not possible. As the following chart shows, private clients, aka high net worth retail investors, have been on a furious buying spree, unlike anything seen in the past decade. So let's have a look at what this is all about. So at the top here we've got hedge funds net buyers. This goes all the way back to the crash of 2008. Nothing really screams there, apart from we can see that we've got a bit of selling coming into the market there. We had some last January as well, when we had a fairly big correction of 2,000 points. The same can be said for the institutional clients here as well. But when we get down to the private clients, the retail buyers, you can see here that there's nothing like what we've seen going back for the previous 10 years. And this is why I keep going on about this. And I'm just going to go to the end of day charts. We'll go to the weekly charts, and this is where you can see this huge volume here. This is a distribution phase. Even though the market has been rotated through December and January and moved higher in February, it is still part and parcel. In order to offload all of the stocks, there has to be a sleight of hand, in that the market seems to be moving up on optimism that is being spouted by Trump and the Republican Party, when really they have absolutely no substance, no policies, etc., to do this. Even with the infrastructure program that they will have to borrow money to do that, which will sink the US economy further into debt. So the whole thing is just smoke and mirrors, and this is why you're seeing this happen here. Now, we haven't got Friday's volume to go into here, but we'll probably see a tapering off. And if we look at the monthly chart, it's a slightly clearer picture. Again, just before we look at 2017, let's look at 2009. Massive buying volume here at the start of the QE, and then this is the greatest volume we've seen all the way through the last 10 years. In fact, the volume has actually dropped off, and now we're seeing all of these retail buyers coming into the market, with the institutions offloading, because they know that what Trump is offering is unsustainable. It is not possible. We've not had a recovery for the last 8 years, and in fact Obama was the only president in history to never have a 3% GDP. So when you look at the backdrop, you look at the background, this is not sustainable. And you can see there you've got 3 months of huge buying, which we've not seen before. Now you tie this in with other things, let's have a look at the implied volatility. These are the charts that I've created myself. We can see that we dropped down to 8.15 here. We started to get a correction, but the retail buyers came back into the market and moved the market higher. There is cause for concern because we've not taken out this 8.15 level when really we should have done if there was no concern. And what I mean by concern, a risk that the market may correct, hasn't been discounted because we've got the volatility levels here sitting around the 10%, well 9 to 10% there. So again, they're sort of saying to us in this chart that, look, we can see the market's going up, but we're not convinced. When we got down to 8.15, well, fair enough, but not anymore. This just seems to be insanity. And then when you look at the 10-year picture, or actually it's more than 10 years, 2006 before the 2007-2008 collapse, you can see that the implied volatility was sitting around these sort of levels here. And if you draw a line across, you'll see this actually being breached as well. We're down in the lows and the market is sitting up in the highs. So again, this illusion that everything is fine is not fine at all. Implied volatility for Friday, 936, down slightly. But again, we've just covered the main facts with regards to this. So let's just have a look at the daily charts from ETX. You can see that we've got a bit of an increase in volume here. There's some indecision coming into the market. We've got the 50% retracement still intact here. The market came down towards this in the early part of the session, but once we kicked off at 2:30, the market then moved back to the upside. The 20,838 high has not been taken out just yet. And then finally for Monday, and as I'm recording this on a Sunday, the news for Monday is pending home sales at 3 p.m. and then Kaplan is going to speak at 4 p.m. Now, like everybody else, I don't know when the market's going to fall or when this is likely to, but one thing to keep in mind as we head into March is that the UK have to trigger Article 50 for the Brexit negotiations to start at some point, and they've got to do it before the 31st of March. Could that be the catalyst if they keep the market on the highs? Who knows, but it's something to keep in mind going forward. That's a certain fact. I can't see the Fed raising rates in March. They have a live meeting the second Wednesday in March, and we'll have to just wait and see what they do, but the consensus is at the moment that they won't do that, but who knows. We're certainly heading towards, I think it's about the 95th day of his presidency or something at the moment, or so I saw yesterday. But whatever it is, it's certainly getting close to the 100-day first 100 days of Trump's presidency there. Right, that's it for today. I'll report in if there's anything untoward. And as ever, thanks for watching. See you in the next one.